Hello. So this week I was invited to speak at the latest Transparency Task Force symposium on the case for radical banking reform. And in this video, I get to explain how our Organisational Maturity Index methodology works, how we calculate total stakeholder value, and I present a whole raft of evidence on the banking sector, how healthy our banks are largely in human terms, and which banks are responsible in generating the kind of value that we all want to see them create for the benefit of society and indeed all their other stakeholders. I also set out a number of recommendations based on the use of OMINDEX for how we can really help banks and certainly other organisations within the financial sector and beyond to become better businesses so that they can serve the needs of society and really generate benefit for us all. Hope you enjoy the video. Thanks.
And we're going to go straight from Kevin Hollinrake to Stuart Woollard. Stuart is very, very generally somebody I admire. He's a thinker, he analyses stuff, he looks at things from the point of view of data and knowledge and understanding, and he really is able to share what the data is actually telling us in such a wonderfully meaningful way. Stuart, I'm going to ask you to unshare for a moment. I'll tell you why, because it's all right. I need to move over to speaker view first. That way we'll all have a larger picture of you when you're sharing your slides. Please do pick up from here and do your stuff. You do it superbly. Thank you very much.
Thank you very much, Andy. Thanks for everybody's contribution so far. It's fascinating to learn more and more about what's going on in the world and how we can try and fix it. What I'm going to do in this presentation is I'm going to present some evidence. We primarily look at the health of organizations through a financial lens. So auditors sign off accounts. The business press reports on earnings, and the market primarily looks at the growth of profitable companies, and that's the primary driver of share prices and how we regard organizations in terms of their success. We look at the health of organizations through a human lens, and we create ratings which mirror the Standard & Poor's type credit rating scale, and our Organizational Maturity Index ratings were specifically designed to create an alternative and complementary indicator to a typical credit rating. And that's the background why you've got that visual on this particular slide, so that we can start to understand that the health of organizations isn't just what the financial records tell us. We need to look at what's driving financial outcomes and increasingly other outcomes, and we'll talk more about those outcomes, good, bad and indifferent, as we go through this. But I'm going to present some evidence on the banks. But just before I do that, a little bit more detail on our methodology. So what we call OMINDEX, or Organizational Maturity Index, rates materiality, the value created and risks reduced in the way a company manages its human intangible factors and across all its stakeholders, so workers, customers, suppliers, regulators. And when I talk about human intangible factors, we're thinking about issues of leadership, management quality, culture, governance, the management of human capital, be it within your workforce or in a supplier context or wherever it may otherwise touch your organization. So these things which really drive value and risk and are ultimately the causal drivers of why corporations fail or that they succeed. The OMINDEX uses 32 diagnostic questions, and they're grouped into 10 core indicators. And on the right-hand side of this slide, you'll see those. So purpose, human governance, innovation, improvement, human capital, risk, culture, stakeholder authenticity are some of those sort of question clusters. The other thing we do with OMINDEX ratings is it forms the basis for what we calculate as what we call total stakeholder value. Now, we talk about shareholder value all the time, and Kevin talked about incentives. And the problems of many organizations, including those within the banks, is that we're incentivized to drive financial return, short-term financial return and shareholder value. and that's typically at the expense of other stakeholders. Our ratings tell us how an organization is creating value across all its stakeholders. And when we integrate a financial performance metric, and for listed firms, we've used price to book ratio as a measure of shareholder value, we've created a new metric called total stakeholder value, which we believe is a much better representation of the totality of value that any organization creates. For the purpose of this presentation, we'll look at the OMINDEX ratings, and you can kind of use the ratings and TSV, or what we call total stakeholder values, one and the same. So that's a little bit about the methodology. Let me just, these are the 32 questions, and before I move on, I'm not going to go through all these, it will take us a long time. Each of these questions is, as I said, causally connected to value and risk. We do not ask the question unless there is a causal connection. We have a set of diagnostic rules which interprets, which underpins how we interpret and judge scores against each of these questions, and we use multiple sources of evidence. One of the sources of evidence we use is the violation tracker, which Andy has been talking about a little bit earlier. And that's an invaluable tool because it's independent and it's objective, and it gives us very hard data. It is not something which the company is telling us to look at. And that's really important. We want to use lots and lots of sources of data, but violation tracker has been great. And it helps us to consider things like question 7 on here is on values. So if you are telling the world that you're a learning organization, but violation tracker is telling us that you have a history of firing whistleblowers, that doesn't seem to support the fact that you're saying what your values are. It's a contra-indicator. Similarly, if you're telling the world that people are your greatest asset and that you're all about workforce cooperation and collaboration, and you've got a history of firing people and unfair dismissal in employment tribunals, again, that's evidence which helps us to get under the skin of an organization and put together robust, objective judgments and scores against all of these factors, which in aggregate give us our rating. Now, slide 3 takes us to a banking sector set of ratings, and we started rating the banking sector properly in 2017. We'd actually done some ratings in 2015 when we first created OMINDEX, but we did a big study in 2017 which was sponsored by Hermes Investment Management, and we were interested to understand to what extent the worst banking offenders in misconduct terms had improved from a human intangible health perspective since the global financial crisis of 2007, 2008. Since then, we've done a number of other ratings. In fact, we've got more banks in the cohort, and some of the ratings we've been updating since 2017. But this is the latest set of ratings, and you'll see on the top right hand of the slide is Handelsbanken. And I think, as Kevin was talking about Ron Taylor, I think Handelsbanken probably represent an organization full of Ron Taylors. And unfortunately, within this cohort of banks, it is the only one that really stands out head and shoulders above the rest. The important thing about this slide is that it's telling us that there's a relationship between organizations that create more value through all their human stakeholders and financial performance, and we've got operating margin plotted against this. So Handelsbanken is our highest rated bank, and it stands out in operating margin terms. And this is data, this actual data, the banking sector data set has been tested by the University of Cambridge Judge Business School. So we're quite confident that the causal connections, the questions we're asking, have a relationship with creating longer term financial value. And of course, the other thing about this slide is there's a midpoint where it says value and risk threshold, and any bank to the left of that is, if these were credit ratings, they would be called junk ratings or below investment grade, and we use the same language. So all those banks to the left of that value and risk threshold are essentially junk ratings in human value and risk terms. So, you know, their cultures are not healthy enough. The way they handle human governance, the way they manage human beings across all their stakeholders, is suboptimal. They're not serving society. And ultimately, they're also not serving their long-term shareholders. And that's a really important message, is that we believe, and the evidence that we've compiled, not just the banking sector, tells us that good organizations and good banks should serve everybody, including shareholders. There isn't a trade-off. There shouldn't be a trade-off. I'm just going to share some statistics. I'm sorry to bombard you with a very, very busy slide. This is part of the other data analysis which the University of Cambridge did. Belle, who's a PhD student, unbelievably talented woman, who works under the supervision of Christoph Lock, who's the head of the business school at the University of Cambridge, put together this data set, so many thanks to her. But I just thought it was interesting just to pull out some of the sort of correlations. The usual caveats apply: causal versus correlation, sample size, etc. But what this is saying is that there's a strong association between higher rated banks, and towards the bottom of the slide, the higher you're rated as a bank, the less likely it is suggested is that you're less likely is you're violating national legislation, less likely it is that you're violating international standards, the less likely it is that you've got controversial products and services. If we go on, and this is a huge data set that she put together, again, the bottom of the slide, if you're lower rated, you're more likely to see fraud. So there's a strong association between lower rated banks and incidences of fraud. You'll see the line a few points up: corruption, bribery, extortion, money laundering. Again, the same applies. What is this telling us? Well, we've suggested that there's a relationship between higher rated banks and financial performance. We're also saying that these ratings tell us and give us an indication of the health of these organizations and the risk that they're carrying, both for themselves, but actually what we talked about tonight, for their local communities, their customers, and society. They are not serving society, and ultimately, these organisations won't be serving their shareholders if well, we haven't seen enough of that, but ultimately our wider body of evidence tells us that it's suboptimal for both the societal and a shareholder perspective. So that's that data. I think just building this and coming on to where I sort of started, we designed this as to sit alongside a credit rating. So this is a nice visual because it shows us that all the banks in this particular cohort have reasonably good credit ratings. And these are reasonably up-to-date credit ratings from 2020. So it's suggesting they're all pretty healthy, certainly from a financial perspective, but it's really telling us that they're not healthy from a culture perspective, from a human perspective, and they are carrying significant risk. Only yesterday, one of the banks in the middle of this slide, Credit Suisse, was on the front page of the Financial Times for a number of scandals and failures, and the head of risk has actually left the bank. And those risk issues that manifest have caused it very serious damage in shareholder terms. So that has very much mattered to that organisation. So here we've got a picture. We need to see the health of our organisations, the health of our banks in a much more holistic sense. This slide I just thought I'd throw in because I was on the call around RBS 10 days or so. Can't remember, like time flies. And I just thought I'd throw it in because this is a book we wrote called The Mature Corporation, a Model of Responsible Capitalism. And we actually highlighted RBS in a section around authentic leadership and trust. Which banks should we trust? And I pull it out because RBS was the bank that scored lowest in the 2017 cohort and continues to score lowest within our OMINDEX rating set. These are things that should matter and should matter to stakeholders. And I think when we come to some of the key lessons and messages, we've got to learn and act upon these things. So, in short, with a few notable exceptions, the banks continue to foster unhealthy cultures. They've got a significant reliance on compliance processes and compliance teams, which are designed to suppress risk. But most fail to recognize or essentially develop the human systems that are necessary for meaningful corporate responsibility. And we all know that poor or toxic cultures, in the words of Peter Drucker, worker eats strategy for breakfast. If you've got a toxic culture, then it will bypass your compliance system, bypass your compliance process. And actually, some of the contributors before me today have talked about that's a systemic problem that goes beyond the banks, because it goes to our regulatory system as well. 2, regulatory audit and board focus has talked a lot about culture and cultural risk, but we don't see any capability, and particularly among regulators, a great deal of willingness to measure the risk of cultures. And particularly at board level, most boards do not have the tools and capability to properly assess, measure and monitor cultural risk. That goes for banks, it does for most organisations. So what are we saying about radical reform? Well, we're actually starting to work with a lot of big companies. They're very interested in our diagnostic, primarily because investors have become interested in it, because they want to understand the risk and value implications of human intangibles. Unfortunately, banks have remained absent thus far, but yet we try and engage with them and get them involved. We certainly want banks to put total stakeholder value or societal value at the heart of their purpose. A lot of companies, a lot of banks are saying they do, but is that really the case? A lot is rhetoric and not reality. As I've suggested, our OMINDEX ratings were designed to sit alongside credit ratings. Our view is that every firm should be required to have one, particularly if you're on a stock exchange. We would love to see regulators say that they're interested in our ratings of organisational health and send a message to banks that this matters. And for auditors who are tasked with identifying fraud and have been hauled up across the coals many times for failing to identify it, not necessarily in banks, but in a number of firms, again, don't have the right kind of tools and capability to identify this kind of risk and report on it. So we can do this and we need to do this. And so we are starting to see it happen. But fundamentally, if we don't understand the health of our organizations as well in human terms as we do in financial terms, then we're always going to be missing a very significant piece. Thanks, Andy.
That really was superb, Stuart. That really was superb. Thank you so much.